Good morning. Jaya Del Rio, helping companies do business in Latin America, appreciates your participation in this webinar, Audit Trends Regarding Transfer Pricing. It's a pleasure to introduce our experts who will develop this webinar, Karina Sevilla Bejar, manager of the tax area at Jaya Del Rio. She's public accountant and has a specialty in taxes. And Maria Jose Gonzalez de Dios, manager of the transfer pricing area at the Jaya Del Rio, who is economist and holds a master's degree in strategic business consulting. Please do not hesitate to send us your questions during this transmission. They will be answered by our experts at the end of this webinar on the questions and answers session.
Thank you, Odette, for the introduction. I'm Maria Jose. Hello, everyone.
Good morning. I am Karina. Thank you for joining us.
Okay, thank you. Today we'll be talking about the trends of the tax authority regarding transfer pricing audits. This talk will be focused mainly on 5 topics that we consider are the most relevant and more inspected nowadays. First, we will be talking about recurring losses and its treatment, then about the companies that have excessive balances with the related parties, also of those taxpayers with financing from its related parties, and those that receive services mainly from abroad, the payment and accrual of royalties, and we will end only mentioning other topics so everyone from this webinar can end up with knowledge of the most relevant aspects. Well, in the case of recurring losses, the first thing to say is that a company that does not operate with related parties will not be willing to operate with recurring losses indefinitely. Eventually, the company will either terminate its activity or leave the market. We are going to mention some examples here. However, it is important to say that as these examples, there are many, and that each company has its own complexity, and therefore is not always replicable the conclusion that tax authority may have from one case against another case singular. Additional to the logic of acting as independent third party, from a transfer pricing perspective, it is important that all requirements must also be met. It shall be considered that the SAT, that is the tax authority here in Mexico, although it is a transfer pricing audit, also identifies those requirements for deductions or accrued income that may be in default and reject, therefore, the deductions or claim income under these principles.
Well, in this example, which is taken from an audit, the authorities determined that the taxpayer could not prove the origin of the losses, and therefore its application against tax profits is rejected. So, but we need to talking about what should be or should we understand as origin of the tax losses. This means that always, in case of a review by the authorities, the taxpayer is the one who is obligated to prove that he's right. How that could be possible? Well, the taxpayer needs to show a different type of documents, such as the working papers with the calculation of how it was determined, also with the work papers showing the amortization applied, and of course it's very important the annual tax return where the tax loss has been declared. Also, there are another kind of requirements as the accounting records and among others, but these are the main importance in case of a revision.
Okay, as another point to consider in the losses topic is to mention, for example, what tax authority does within a transfer pricing audit, which is to analyze the taxpayer and compare it with the behavior of the companies of the group, which the taxpayer belongs, if it is public information. Therefore, the SAT analyzes the financials and the tax behavior of the companies of the same economic group, and if it identifies that the rest of the group of the entities with similar functions do not have recurring losses, indicates incongruity and therefore could demand to the company a market profitability for the income cases or could make intercompany transaction non-deductible. This is a paragraph from a transfer pricing audit. What I would like to highlight from this wording is that the authority from the review of the annual report from the corporation to which the taxpayer belongs, and that is public information, mentions that it was possible to identify the profit margins for the diverse activities within the group, and that when comparing the profit margin of the company with that of the entities of its group, it was visible that the entity's behavior was not consistent with the reported with the multinational group. The authority continues saying that the group's behavior reveals whether the profits of any territory have been transferred to another jurisdiction with the objective of minimizing the tax burden. And finally concludes that the company is not congruent with the financial results of the other members of the group, and therefore the taxpayer did not demonstrate that the reported operating loss is due to factors outside under which transactions were executed with related parties. In other words, that is that the loss is due precisely to the practices that it has with its related parties.
In conclusion, the fact that the authorities reject the loss and not allowed its amortization to be applied against the tax profits, it's not only for the year under the review. The implication go further because we cannot forget that the audits are made to previous years, so maybe 3 or 4 or something like that. And this means to modify all the figures for the tax year in revision and the subsequent ones. So this is very important aspect to review in these cases.
Yeah, that's correct, Karen. Well, the next topic we're going to talk about is the excessive intercompany balances. In this case, and in every case, what it is expected from a transfer pricing perspective is that companies, when carry out their transactions with related parties, act as independent third parties in similar conditions will do. Therefore, the associated to this particular aspect, an independent third party generally invoices and charges for the services or products in a reasonable period. If the SAT, in case of a review, decides to apply an adjustment related to intercompany balances, this could have implications in withholding taxes aspects, exchange losses, probably thin capital issues, and finally, it can modify the transfer pricing analysis and therefore the conclusions obtained. Later, Karina will delve a little deeper into these topics. Here, we have another case in which the company had a long-term loan with its related parties that accrue interests and additionally had payable accounts that exceeded 200 days. Therefore, within the review, the tax authority's observation was in the sense that in addition to having the loan, the company was actually financing its activity with account payables with its related parties that caused exchange losses. In this specific company, there was already a negative equity, and this was associated, according to the taxpayer, mainly due to the difference in exchange rate, which had caused the company accounting losses. Tax authority continues and mentioned that despite this, the company continued operating normally, and this was only possible because the precarious financial situation it presented was artificially created. By the way, the financing with related parties was structured. It's instead of providing capital, the related party gave accounts payable with interest accrual and exchange loss. Given this, the SAT in this particular case proceeded to apply an adjustment, determining the accounts payable that company had in excess. This comparing the days of payables that the entity had against the days of payables of the comparable companies. And the amount that they obtained that did not correspond to the days obtained by the comparable companies is what they call excess, and proceeded to also calculate the exchange loss that would correspond proportionally. And therefore concluded that this excess is really about financing received from its related parties that has more similarity with capital contributions, but in this case, the authority classified it as debt and then review if the entity complied with thin capitalization rule that Karina will now explain in more detail. Well, clearly in this case, the taxpayer did not have any capital and fell into thin capitalization rule, and therefore all the interest from the surplus in payables with related parties were non-deductible.
Well, the fact that the authorities conclude that this operation should be considered as a loan implies that the company must perform a calculation established in the income tax law to determine whether or not the interest or the foreign exchange losses arising from the operation are deductible. So this calculation is called as thin capitalization. That roughly means that those who are over in debt with the related parties and their capital are not able to withstand such liabilities. So which are the implications? Well, modify the tax base, not just for the income tax law, also you need to modify the profit sharing base in case of apply. Also, we can have another implication, which is to pay more taxes, or if you have a loss that could be increased. Also, if you have a profit in the previous year and you was using a profit coefficient for the next years for payments in advance, that could be a problem because you need to modify also the figures for the following years. So this is not just that the authorities classify this as a loan for this year. It's also all the subsequent years that could have another taxes implication. No, Maria Jose?
Yes, correct. Well, the first topic that we are going to talk to see today is the interest accrued with related parties. In this case, the authority review form and substance aspects. And therefore, if the SAT establishes after a review that a transaction was not performed as third independent parties would do so in comparable situations, this could lead to the rejection of deductions and exchange losses associated with the transaction. One of the reasons for this type of transactions to be audited is because a company with poor financial performance will not receive credit from an independent third party. Here, we wanted to present an example of what the authority is requesting in relation to interest transactions. In this particular case, the company had been required to explain the reason for the loan and the documentation that demonstrates that the funds were invested in the business purposes. The taxpayer here provided an explanation of the use that gave to the funds. However, the authority considered that this was not enough and in fact says that the company ignored to present documentation that supports the business purposes that originate the loans. That is to say, documentation and information that support that the loan was actually used to cover what was said was the purpose, and further argues that it was taxpayers' obligations to keep, and on the request of the authority to provide documentation proving that its income and deductions were performed as independent third parties in comparable transactions. And finally, well, the authority concludes that by not providing that supporting documentation to verify that the loan was for business purposes, it also does not demonstrate the strict indispensability of the expense, and therefore the deductions did not proceed.
There are different requirements to consider the interest as a deductible. The main one is that the money must be invested in the purposes for which the company was created. These requirements, of course, are, and the main important thing to establishing here is that all the money must be invested in acquisition, in expenses, in salaries, and all the things that could help to the company to continue with a regular operation. This is the important thing that the authorities review in these cases. So, Marijo, I don't know if you want to add something else in this slide.
No, I believe that actually what tax authorities said, and it is important, is that the tax requirement must be met. And I spoke about that in the recurrent losses, but here applies the same. I mean, you cannot deduct an interest expense if you do not comply with the rules of deductibility, but even if the transaction from a transfer pricing perspective is correct.
In this slide, we can see a thesis issued by the court in which a summary tells us that the taxpayers previously just with the contract and the corresponding payment was sufficient for an audit, but this was for many years ago. Now the tendencies in an audit is that in addition to the contracts, of course, to the payment, of course, The work papers with the calculation also be a part of this file. They are trying to verifying that the transactions are at the market value and the business reasons. And it's very important that the money was used in the business operations. So as a summary, now the audit or the auditors or the authorities are requesting all the proofs to determine that the transaction was real.
Okay. Well, and I think we're going to see that that works also and works for every transaction for the services. In the case of services, this is a transaction that always worry my clients since it has become a highly audited transaction, and it seems that it's not possible to have enough information to demonstrate that the expenses for the services are either strictly indispensable, that were actually rendered, or that the price agreed is correct. In this case, what the authority in general will assume, among other things, is that the companies abroad could be receiving money for services not provided and or unnecessary, and therefore establish that the transaction was not performed as independent third parties and proceed to non-deduction of them. Although many of the services that the Mexican entity receive are charged in a traceable way, in many cases, what the corporation does is to determine assigning a pool of cost what corresponds to each of the countries that use their services. And this assignment can be done in many ways. In Mexico, the pro rata expenses in principle are non-deductible, unless certain rules emitted specifically for this topic are complied. The pro rata expenses rule mentions the requirements needed for the expenses to be deductible. It is important to mention that the tax authority usually asks for the information for the services transaction, even if it's not a pro rata expense. In this case, that the expense be strictly indispensable, that has actually been provided, and that has been made just as independent third parties. The transfer pricing guidelines set forth in the law are complied with, and that there is a reasonable relationship between the expense incurred and the benefit received or expected to be received. Another important point to mention is that under no circumstances do billing and or paying prove by itself that a service was actually provided. In relation to this last point, there is a contentious administrative trial. The Superior Chamber of the Federal Court of Administrative Justice unanimously resolved that within the faculties of verification of tax authorities in this exercise, it can validly ignore the tax effects of legal acts recorded in accounting when they lack materiality. And well, this is completely aligned with the OECD guidelines and BEPS aspects. Simply what it is determined is that the economic substance will prevail over the form aspects. And therefore, if the authority warns that the recorded transactions in accounting have no material substance, may determine its inexistence for tax purposes.
The information usually requested by the tax authorities in an audit could be, as we talked about some slides ago, it's the contracts, the payment, the invoice, but the very important thing here is to have all the documentation to prove that the service were effectively rendered. That's exactly that the authorities are requesting now. You can provide anything you want, but if those documents doesn't prove that the service was really rendered, your audit will not be in your favor. And this is very important to know.
Yes, I think it's probably things about supporting documentation, and it is related also with the next topic, that it is royalties. Here also they're gonna try to have information or documentation that proves that you have to pay the royalty. It's an important issue. Usually transactions that attracts the tax authority attention is the accrual of royalties. The authority's postulate is that an independent third party will not pay a royalty for a brand, technology, or any intangible in general that will not generate a tangible benefit to the company. In this case, the entity paid royalties. Well, I'm going to present the case. The entity paid royalties for both trademark use and know-how. In both cases, the authority concluded that it was not possible to verify the relationship between the agreed royalties percentages, the value of the intangibles, what was paid, and what was paid on the profit that the taxpayer will obtain for the use and exploitation. This is a broad subject, such there is no guide that points how to make this demonstration. The closest are the OECD guidelines that include discussions of BEPS actions, and then finally suggest a deep functional analysis where they are reviewed. In relation specifically to the intangibles, the functions known as DEMPI functions, meaning the development, enhancement, maintenance, protection, and exploitation of intangibles. And once this was determined, it could be reviewed that the operation has an economic meaning, and then you can charge for intangibles. Another point that the tax authority highlighted in this case was that the company had several years making payments for know-how, and therefore questioned whether all these years the company did not know how to manufacture or market its products, as they continue paying a royalty for the use of the knowledge. Additionally, also mentioned the company's history and how the group had been operating for many years, and therefore the products are mature and in recognized markets.
Regarding the marketing expenses, the Superior Court room established that this kind of expenses are completely deductible. Why? Because they are directly related with the product. Why? To render the conditions and the distribution channels and directly the sales. And these are not involved with the brand. So that's why they are allowed, and those could be a deductible expense. So the difference between the promotion and advertising that are not deductible, it's because the promotion and advertising are not an strictly indispensable expenses. Why? Because these are related to add value to the brand. So if I am not the owner of that brand, it's not possible to me make expenses for increase that part. The rules that a taxpayer needs to comply with make deductible this type of transactions are that the expense, it's necessary to be strictly indispensable for the purpose of the activity. Of course, also we need to have the documentation, and we need to have the agreements, and we need to have an invoice and payment and of type of proof that the service was rendered. In the specific case of the royalties, is in which is the real benefit for that operation. Also, that the expense needs to be placed in the corresponding tax year, and also the deduction will be carried out in the same fiscal year.
Okay, well, other issues that we wanted to talk about, we're not going to go deeper in these topics, but we wanted to mention other aspects that tend to be audited transactions in terms of transfer pricing. Finally, we're not going to go deeper into these topics, but we wanted to mention some other aspects that tend to be audited transactions in terms of transfer pricing. In the first place, business restructures. As many of you know, the Mexican entities here in Mexico must give notice to tax authorities of restructures that they have. But it is also known that restructures within a multinational group tend to be focus of attention, and tax authorities do share this kind of information. Another relevant topic is the atypical behavior in the payment of taxes. For example, the company has been reducing its effective tax rate from 25% in one tax year, and the subsequent years the effective tax rate is 10%. Tax authority probably will seek the company to review the taxpayer. Also, any omission of statement that the company does not comply with transfer pricing within the Appendix 9 of the multiple informative return, the questionnaires of the statutory report, etc., or that there is no consistency in the crossing of the information that the SAT possesses could be focused for review by the authority. And finally, significant transactions with related parties in low tax jurisdictions will be transactions observed by tax authorities.
It's important to consider, additionally, to have all the documentation, all the agreements and the contracts and the work papers with the correct calculations to make a functional analysis for the transactions to prove that the economic substance of those are online with the OECD rules, and also that to prove that all the documents exist, you need to review too that all the tax returns, annual ones or informative ones, were correct filled before the authorities on time and comply with all the requirements established in the federal tax code, because it's important to say that the authorities are not reviewing only the substance. They never going to forget the form, and they will also review all this in an audit. And finally, in here we want to show what kind of fines the authorities can give you as a taxpayer if you fill the informative return with mistakes, or even if you not fill it, you can have this kind of fines, which is from 77,000 pesos to 154,000 pesos. So also the local, the master and the country by country informative return exhibit, also they can give you a fine which is from 154,000 to 20,000 pesos.
We will start a questions and answer session. If at the end of this blog any question remains unsolved, we will contact you as soon as possible to provide the answer. Additionally, we would like to remind you that this webinar will be available on our YouTube channel. Okay, Majo, I think this question is addressed to you. And this one says, how does the presentation of the local file, master file, and country-by-country report to the tax authorities in Mexico affects the triggering of transfer pricing audits?
Well, in Mexico, the first relevant change is that the local file for those taxpayer obligated is presented directly to tax authorities. Unlike previous years, the transfer pricing studies were submitted to the SAT upon request. Currently, with this return, the SAT has first-hand information, which will facilitate the inspection. In the case of the country-by-country report, for example, given the information exchange facilities between the countries, the authority may know the tax positions of the companies within the group and determine, for example, the tax base or the effective tax rate in Mexico does not correspond to the rest of the group in similar circumstances. Or, for example, with the master file, the authority will have the knowledge of the structures within a group and mainly the capability to identify the intangibles and thus to verify that all expenses related to intangibles are being disbursed by the entity to whom corresponds such payment.
Okay, thank you really much for this answer. And the next one says, if my company has technical assistance and know-how expenses, will both concepts be deductible?
Well, here the answer will always be that they shall be reviewed on case-by-case basis. In principle, it will be necessary to verify that both charges are reasonable in relation to your company's activity, that there is a clear distinction in what each charge refers to, and mainly in how the amount is calculated, and hence a series of reviews that we can gladly see in more detail.
Okay, thank you very much for this answer also, Majo. And the next one says, what is the period of the SAT to start a transfer pricing review?
Well, the period is 5 years from the last annual tax return is filed. That is, if you today present a complementary return for fiscal year, 2017, the 5-year review period for the fiscal year 2017 begins today.
Okay, and I think for this session, we will reply to this last question, and the remaining questions will be solved directly by email, okay? This last question says, are domestic transactions also audited?
Well, that's a good question. Yes, the transactions between domestic related parties are subject of review. In this case, the tax authority allows, however, when it establishes an adjustment as consequence of an audit process that can be applied to both national entities. So the complexity in national transactions is, well, among other things, the effect that these adjustments will have in calculations and payments of other tax or obligations, not necessarily for income tax.
Thank you really much, Majo. Well, now we have reached the end of this webinar, and Jaya Del Rio, helping companies do business in Latin America, appreciates your interest and remains at your disposal for any further question or query you may have at contacto@jayadelrio.com. Thanks, Karina and Maria Jose, for such interesting presentation.
Thank you.
Thank you.